Hey everyone, so I just wanted to do a quick video on how to determine whether or not this is a deferred tax liability versus deferred tax asset. It's just a little quick trick I caught on while taking 352 last semester, and I just wanted to share it with you all. So again, this slide pretty much already says deferred tax liability, but let's say it wasn't, right? In the exam, it's clearly not going to say, oh, it's a deferred tax liability. It's just going to have this portion right here. So how are you going to know whether or not? I mean, again, you could read it. You could read the scenario. That's one thing to figure it out. But another easy way is this little trick I got for you. So the main thing is, what's going to determine whether or not it's a deferred tax liability or a deferred tax asset is by looking at the first year and comparing pre-tax accounting income versus your taxable income. Now, since 140 is greater than 100, I do this little trick. So it's a sign, but I don't really have a stylus. I'm a little ghetto right now. But anyways, so since 140 is greater than $100, you have this sign. So this sign is equal to liability. Okay. So let's say let's change the scenario, right? What if this one right here was the 140 and this one right here was the 100, right? And this was year 2018. Okay, again, you have to look at the first year. This is what determines whether or not it's an DTL or a DTA. So let's say in 2018, the scenario was switched where the pre-tax accounting income was $100 or $100 million, and then the taxable income is 140. So now this becomes this sign. Oh, see, it did it for me. It looks like an A, but what I really meant to do was, kind of show you that this is greater and that this sign, oh, it keeps doing that, that this sign is equal to asset, right? So that's just a little trick. And then again, from there, that's when you do your journal entries. So looking at the original scenario, let's do the journal entries. So in this case, income tax expense is debited 140, which is your pre-tax accounting income, the top row, times whatever year or whatever tax rate it is for that year. So in this case, it's 40%. So it's 40% times 140, which is 56. And then you credit your income tax payable. And it's again 100 times the 40%, which gives you 40. And then DTL, the normal journal entry for that is credit. So DTL, normal balance. There you go. I couldn't find the word. Is gonna be the difference. So it's 16. Cool. So this is for the year 2018. Now we look to see the rest of the years. This is greater, this is greater. Now it doesn't change to deferred tax asset. It still stays as DTL, right? You can't reverse an account with another account. That doesn't make sense. You have to reverse it with the same account, right? Because it's a temporary difference. So what's happening is you're pretty much, it's coming back, or it's fixing itself. That's essentially what's happening, right? So for 2019, so this is 2018. So for 2019, you have income tax expense of 100 times 40%, which is 40. And then now, since the taxable income is greater than the pre-tax accounting income, instead of having your deferred tax liability as a credit, it now becomes a debit. DTL, and it's going to be the difference of 110 minus 100, which is 10, times the 40%, which is 4. And then you credit your income tax payable, which is 44. Cool. Okay, now, oops. Now let's look at the last one. So for 2020, you have income tax expense. Wow, my writing is just getting worse. I forgot how to write. Income tax expense, again, it's going to be 40. And then since that's greater, the taxable income is greater, where does your DTL go? Debit or credit? Debit. Okay. Right, DTL, and it's going to be the difference, so 30 times 40%, which is 12. And then you're going to credit income tax payable of 52. And there you have it. That's how you do that. And then we can do one that's deferred tax asset. Ooh. All right. Let's now talk about deferred tax asset. Again, your exam is not going to say deferred tax asset, right? It's going to be too easy. It's just going to give you this whole scenario. You're going to read it accordingly and determine whether or not you're going to be doing deferred tax asset or deferred tax liability. And just to be consistent, since I did use red for the asset here, I'll be working with the red pen with this problem. Sorry if it's wobbling. My phone right now is harnessed by what do you call those? The keychain necklaces? I don't know, I'm fob. I forgot what it's called. Anyways, you know what the heck I'm talking about. Let's move on. So this is the whole scenario. It gives us the pre-tax accounting income respectively, 70, 100, 100 million, right? And then it tells us that there was a 30 million warranty expense in 2018, so that gets added and later on deducted as the years go by because it's being used, right? So pretty much, again, it's a temporary difference that you will eventually reverse and like correct itself, essentially. So once you have that, again, the biggest thing is looking at the first year and seeing whether or not pre-tax accounting income is greater than taxable income, and then that's how you go on doing your journal entry. So just to remove this portion, since we already, the math's already been done, I'm just going to remove it. That way it's a little bit clearer and easier to see. And now we're going to compare $70 versus $100, and we see that 100 is greater. So again, it's that sign, right? I'm trying to show that it's greater. So this sign equates to asset, to the little trick. And now you do your journal entry. So in 2018, 12/31/18, or 2018, right? I'm just writing the whole date. Your journal entry is as follows. Again, income tax expense is the $70 times what's your tax rate this year? 40. So that will be 28. And then deferred tax asset is which normal balance? It is a debit balance. So deferred tax asset is over here, but what is it? It's going to be the difference. So 100 minus 70 is 30. 30 times the 40% is 12. And now you're going to credit your income tax payable. And that is equal to 40. Cool. And then you move on. Now you know that 100 is greater than, and again, I just want to reiterate, this sign doesn't make it a deferred tax liability. It stays as a deferred tax asset. However, you do reverse it. So a way to reverse it is not with the deferred tax liability, but reversing it with itself, but on the credit side. So in 2019, you have income tax expense, and that's going to be 100 times the 40%, which is 40. And then you have your DTA, or you can do income tax payable. I think honestly it's easier to do income tax expense and then debit income tax expense and then credit income tax payable, because those two never change, they never switch. And then it's always just going to be whatever the tax rate is for that year, multiply it by whatever the value is, and it stays that way. And then you just got to know whether or not it's a DTA or a DTL, and in which debit or credit side is it. So in this case, since now pre-tax accounting income is greater, you know that DTA is going to be over here, but what's the value? Again, it's just going to be the difference between the two. So income tax payable is 85 times the 40%, which is 34. And then now you can just do the difference, which is 6. So that's 2019, and then 2020. Income tax expense. I'm even just gonna write down the journal entries, and then I'll put the numbers later. You know, it becomes easier as you go. So now income tax expense is 100 times the 40%, so it's 40. Oh, literally it's the same exact journal as 2019. So income tax payable is 85 times 40%, which is 34. And then DTA is going to be the difference, which is 6. Again, when I say difference, you know, like sometimes if you get confused, or a way to check it is what you do is 100 minus the 85 and then times 40%. And that should be your DTA. You know, same thing. Okay, and that's deferred tax asset for y'all.